Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look yet again at financial earnings results, and we're talking today about the conglomerate sector, both Massy Holdings Limited, or Massy, as well as Grace Kennedy Limited, or GKC. Both groups would have reported increased earnings for their recent respective financial periods, Massy for their fiscal 9-month period, as well as Grace for their fiscal half year of 2023. Let's take a look at how both groups would have performed and what investors might expect in the coming months ahead. Turning firstly to Massy, well, the group would have recorded an earnings per share figure of 24.5 cents per share, which is pretty much in line with its prior comparable reported figure of 24.5 cents. So just a very marginal 0.04% increase, but take that with a pinch of salt, with earnings from continuing operations having a fairly significant increase, which you would not see on this particular slide. Now, revenue from continuing operations actually improved 12.5% from $9.2 billion to just about $10.35 billion, with operating profits after finance costs improving 22.7% from $614.8 million to just about $754 million. Overall, profit attributable to equity holders relatively flat, $484.5 million in the prior comparable period, compared to $484.8 million in the most recently concluded period. Again, the ultimate number is not telling the full story, given that profits from continuing operations would have improved markedly. Now, when we take a look at profit before tax by segment, we can see there was some notable improvements in all of the major segments. In the integrated retail segment, for example, there was a roughly 19% increase from $364 million to $433 million, period over comparable period, a 5.1% odd increase in gas products from $212 million to $223 million. Motors and machines also improved from $135 million to just about $142 million, again, another 5% odd increase. And that gas products segment, given recent acquisitions, particularly IGL Limited, the Jamaican LPG and medical gases distributor and manufacturer, that should improve in coming quarters post-consolidation. Now, when we take a look at PBT by geographical composition, ultimately that profit before tax figure continues to grow, but on a relative basis rather, there have been some fairly notable changes. For example, Guyana now accounts for 25.7% of Massy's PBT compared to 15.9% in that 9-month period of 2019. Trinidad and Tobago in that red segment, however, would have decreased in overall contribution to PBT from 43.5% in that 9 months of 2019 to 37.5% in the most recently concluded period. So we can see changes in that composition, which is good from a diversification perspective for shareholders of Massy looking ahead. Jamaica is expected again to grow in prominence as as Massy consolidates that IGL Limited acquisition in subsequent periods. Now, from a historical PE trends basis, we can see again that trading earnings per share relatively stable for now. But on a continuing earnings basis, most of that 41 cents on a trailing 12-month basis would have been comprised of continuing earnings. So we can see as well, in terms of the price earnings ratio, that Massy has stabilized at around 11.4 times. Is that a good valuation? Well, we talk a bit about that shortly. Now, at that price of $4.69 per share, Massy is trading at that price earnings ratio of 11.4 times, below the sector average of just about 16 times, and offering investors a dividend yield of 3.4% compared to that sector average of 3.1%. So on the basis of continued revenue growth and earnings growth also driven by acquisitions, relatively fair valuations, perhaps a bit undervalued, that continuing that geographic diversification and relatively attractive dividends versus maintaining its overweight rating on Massy for the time being. Turning quickly to Grace Kennedy Limited, or Grace GKC, well, the group would have reported diluted earnings per share of 18 cents per share, TT equivalent, a 14.5% increase from the 16 cents recorded in the prior comparable period of half year 2022. Revenues were up 7.2% from 3.1 odd billion to just under 3.3 billion. TT equivalent overall net profit attributable to equity holders increased 18.4% to 196 million. TT equivalent from 170.8 million. Now, in terms of profit before taxes by segment, GKC's main driver of this performance was its food trading segment, increasing from 133 to 172 million in that foreign segment there, roughly a 30% increase. Now, there was also a 33% increase in its insurance segment, growing in that thing segment from 24 million to 32 million, driven, of course, by some acquisition activity as well. Banking and investments would have had not the best of first halves of 2023, falling from 34 million to 17 million, a roughly 50% decline on account of volatile financial markets. One of the major important pieces of information for investors is that margins continue to improve for GKC, or margins continue to recover at that half-year point of 2023. Operating profit margins grew to 7.8% from 7.13% in the prior comparable period, while PBT margins also recovered from 7.18% to 7.85%, again, are reflective of perhaps cooling inflationary pressures and recovering overall profitability and that ability to translate every dollar of revenue generated into profits for GKC shareholders. And when we take a look at the valuation story for Grace Kennedy, we can see a moderation in price to earnings ratio, falling to its current level of around 10.3 times, suggesting that investors are getting a bit more value in terms of the price they pay for the stock versus every dollar generated by GKC. So again, at the price of $3.34, GKC is trading at 10.3 times in terms of its PE ratio, below the sector average of 15.8 times, offering investors a dividend yield of 2.7% versus the sector average of 3.1%, and those dividends are actually paid in US dollars as well. So with improving margins, revenue growth, relatively attractive valuations, and continued acquisition activity, Bourse is going to maintain overweight rating on GKC for the time being. Well, that's it for this edition. For more information, you can give us a call at 226-8773, email us at invest@boursefinancial.com, and of course, check out our website, bourseinvestment.com, where all of our research is absolutely free. So that's it for this week's edition, and you can do have a very profitable, happy, and safe investing week, and we'll see you next time on the Bourse Report.